Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. In this particular video, I'm going to take a look at 15 good companies that I believe are trading at attractive valuations, or at least fair valuations currently. This is in line with the popular and famous Warren Buffett quote that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So what I've done here is I've looked for high quality dividend growth stocks. They had to be A- or better rated. I'm looking for good valuations, PE ratios, generally 15 or below, and no higher than 18 or 19. I've got one company in that category, which is PepsiCo. In the case of, I'm going to include one real estate investment trust or REIT, Simon Property, but here we're looking at price to cash flow, or in this case, price to FFO instead of PE ratio. But otherwise, we're all below the 18 PE ratio that I talked about, with the exception of Pepsi. Now, from a standpoint of dividend yields, these stocks range from a low of 1.6% to a high of 5.3% with Altria, or the old Philip Morris. And what I'm going to do is I'm going to do this in alphabetic order. I'm going to go into each of these companies and show you why I think they are great long-term investments at today's levels, in spite of the fact that we are in a major bull market where stock prices are generally extended. I believe all of these stocks can be purchased today at attractive valuations and are great opportunities for long-term growth of capital and dividend income. But primarily, even though the dividends are a major part of what I'm going to be showing you, I think these particular candidates are about building a dividend growth portfolio of quality companies at fair value for long-term total return. With my first candidate, we're going to look at the biotech company ABBV. I'm going to start out by just looking at ABBV from a standpoint of earnings per share and earnings per share growth, because one of the things that all these companies will have in common is that they will have above average earnings growth rates. Now, this was a spin-off from Abbott Labs, and you'll notice since 2013 the earnings have grown from $3.14 to $5.60 last year, and expected to be $7.84 this year. So this growth rate, including estimates for 2019 and 20, average growth of 14.3%. Just go ahead and add monthly closing stock prices to that graph. You can see that the price has gone where the earnings have gone, and when the price is below the orange line, which I believe represents the intrinsic value at a PE ratio of 15, then the stock is attractive. When it's above the line, it's slightly overvalued. But even being slightly overvalued doesn't mean you can't make money. It just means you're going to make less at higher risk. And then, of course, I believe the stock is currently undervalued with a blended PE of 12.5 and a current dividend yield of 4.2%. From a performance point of view, had you invested $10,000 when it was spun off, that $10,000 would have grown to $26,900 versus only $19,800 had you bought the index. But I think equally important, you would have gotten $3,600 in dividends versus only $1,500 in the S&P, using round numbers. So it's a difference between a 21.2% annualized rate of return versus 14% in the market. Now, the company's dividends and their dividend payout ratio has also, as you can see, been very consistent and growing, and dividend growth has averaged over 13% per annum, both on a compound annual growth rate and an average growth rate. So I consider the stock very attractively valued at today's levels, with a very nice dividend yield. And, as those dividends have been paid out, the investors have received the capital appreciation plus all this income that was, once part of the company. The area below the white line is the dividend payout ratio. Looking to the future, the company is forecast to continue growing at about 14.7% a year through 2021 on average. We're looking for 40% growth this fiscal year, which obviously ends in December, and then we're looking to add another 15% on top of that in 2019, followed by 8 and 5. The long-term trend line growth rate is expected to be 12.9%, and I might want to add that based on forecasts, the analysts, when they were making their forecast 1 year in advance or 2 years in advance, have been 100% in line, with a 10% margin of error for the 1 year and a 20% margin of error for the 2 year. So long range potential is for this company to generate double-digit returns going forward. If you're looking out to the long run growth, if you're looking at the next couple of years, the rates of return could be very attractive, actually in the 20+% range, 27% range through 2020, and that's assuming assuming that the company earns the type of earnings that are being forecast here, as they have historically met in the past, and the market values it at a very sensible PE of 15, up from its current PE of 12.5. With my next research candidate, I'm going to look at the healthcare distributor AmerisourceBergen, and I would like to point something out. You're going to see a couple of healthcare companies, a lot of financial companies, but even though they're in the same general industry, you'll find them in different sub-industries. So I'm going to go a little quicker now. You've got AmerisourceBergen here. It's had historical growth of 17%. So therefore, using the PEG ratio of 1, or PE equal to growth rate, the orange line is drawn at a PE ratio of 17.3. And you can see how the stock price has tracked that. And every time it's gotten below that valuation, it has moved back in alignment. And when it's got above that valuation, it's moved in alignment. I think the stock is very attractive at a PE of 14.2 with a 1.6% dividend yield. Its historical track record has been far superior to the S&P over this time frame. A $10,000 investment would have grown to $136,000 versus $25,000 in the S&P. The dividend income on that $10,000 investment would have been $12,900 versus $4,500 in the S&P. Significant outperformance across the board, and that's even measuring it at this low level of current valuation. With my next research candidate, I'm going to look at Ameriprise Financial, which is an asset management and custodial firm. This is one of the many financial companies that I'm going to be showing you throughout this presentation. Once again, we have way above average growth of 11.1%, which is significantly better than what the market did. We have a nice growing dividend. We have a very low payout ratio in this example. Their current payout ratio is around 30%, and it's been in the mid-20s and even the teens prior to that. Once again, we have strong outperformance, long-term outperformance. 10,000 would have generated 5,000 in dividends versus 3,000 in the S&P. 10,000 would have grown to 38,000 in capital growth or capital appreciation versus 23 for the S&P, and that's a total of almost 44,000 versus 26 or 12% versus 7.6%. Once again, we have forecasts for very strong growth, 17% going forward. This would indicate very strong potential rates of return if the company went back to a PEG ratio of 1, or the PE ratio went back up from 9.9 to a more normal 17. Their historical normal PE ratio for the last few years has been 14. So, if you want to be real conservative with your approach, you might go ahead and utilize this. You still would have rates of return in the 20s and 30% range going out further. So I consider Ameriprise very attractive at today's levels. My next research candidate is BlackRock, the world's largest money management firm. They offer ETFs, funds, separately managed accounts, $65 billion market cap, AA minus. They have 13% debt. The company currently trades at a PE of 15, which is significantly below its earnings justified valuation of a PEG ratio of 1, or growth of 19.5%. So it's a big discount. The company offers 3.1% in current dividend yields, and once again, you can see how price has tracked earnings. It did get slightly overvalued in 2018 and then has now recently become undervalued, as most firms in this industry are today. A $10,000 investment in BlackRock in October of 1999 would have grown to $267,000 versus that same investment only growing to just over $21,000 in the S&P. It would have generated over $50,000 in dividend income for a total rate of return of 20% a year versus only 5% for the S&P. This has been a terrific growth story, and it's currently available at a very attractive valuation. Near-term forecasts are for 14%. Long-term forecasts likewise at about 14%. So I believe even based on these lower than historical norms, you still have the opportunity for significant double-digit rates of return with a very attractive dividend yield in a AA minus company with only 13% debt. The next company on the list is Comcast Corporation, which is obviously in cable and satellite. I'm going to shorten the graph here to get rid of some of this high valuation. You can see since just prior to the Great Recession, the company has grown earnings at about 23.2% a year. So here, once again, we have a PE ratio, a fair value PE ratio of 23.2, which is equal to the company's growth rate. It's A- rated, has 43% debt to capital, offers a dividend yield of 2.1%, and is available at a blended PE of 14.9. Once again, even considering, I want to point out that the stock was overvalued at the beginning of this particular time frame I'm showing you. it still dramatically outperformed the S&P, almost 2-to-1 on capital growth and significantly more dividend income, and a total annualized rate of return of just under 13% versus only 7.9% for the S&P over this time frame. They started paying a dividend actually in the throes of the recession, and if you'll notice, they've increased that dividend at approximately 20% a year since they've been paying one. So it's a very attractive opportunity to invest in an A- rated company at a very attractive valuation relative to its historical growth and potential. My next research candidate will be Intel Corporation, and once again we see an example of a company that is undervalued. It's a little more cyclical if you look at the long-term record than a lot of the companies, and just because it is a tech stock, it was significantly overvalued in calendar year 2000, which was the peak of the irrational exuberant period. I wanted to point this out because I think it's important. This was referred to as the irrational exuberant period, but more specific to Intel as the tech bubble, and it really shows how crazy stock prices can be in the short run. But as I take time off and as that craziness kind of, as I call that out, you can see the company's grown at a nice 8% rate, which is above average, offers a 2.6% dividend yield. It's A+ rated, only has 26% debt to capital. It has not outperformed the S&P historically, but it's also undervalued today relative to the S&P. The S&P is overvalued, but going forward, we're looking for 9.5% to 10% growth. The long-term forecast is about 9.3. Based on a normal PE ratio of only 15 times earnings, this would indicate double-digit rates of return. And once again, we have a very good analyst scorecard. I haven't shown it to you for every company, but the analysts have been pretty on the money. And I think it's important to show for this company because it is a tech stock, and as I pointed out, it's more cyclical than most of the stocks that I've covered so far. My next candidate is Illinois Tool Works, an A+ rated company with 51% debt. It offers a 3% dividend yield. It does have a higher PE ratio than any of the others I've shown you, but it has a very excellent dividend record. I want you to notice that their dividend has grown at an average rate of 13% a year, which is one of the things I was looking for. It's produced significantly more dividend income than the market and more capital appreciation. It generated an 8.9% rate of return since December of 1998 versus 5.7. But I also want you to notice it tends to sell at a premium valuation. Consequently, Illinois Tool Works, and likewise, as I'll show you a little later in Pepsi, sometimes from a valuation perspective, it makes more sense to look at it from an operating cash flow. I also want you to notice operating cash flows are clearly covering the dividend, but the stock got significantly overvalued on the basis of operating cash flow. Coming into 2018, it has since corrected to a level that's more in line to just slightly outside of its normal priced operating cash flow of 15 times earnings. I consider this a very attractive long-term investment in an extremely high-quality company. Does not quite have the return potential of some of the others, but it certainly has the quality characteristics that make it worth considering at this time. My next research candidate is JP Morgan. Now, I do want you to see some of the cyclicality that the company, this bank, it's a diversified bank, has gone through. It did a little better than some of the big money center banks like Citicorp or Bank of America during the Great Recession, but they did cut their dividend. But I do want to focus on what this company has done since the Great Recession. I can even go back one more year here for you. The growth has been about 24%. If I shorten it a little bit, it's still over 15%. Take out one of the really big numbers. I'll shorten it one more time. It's still growing at double-digit rates, around 10.5% to 11%. It's currently available at a 12.4 blended PE, offers 2.9% dividend yield. It's A- rated, and debt isn't actually reported for banks, so don't get confused with the 0% debt. Anyway, it's forecast to grow at 15% over the next couple of years. That would once again generate 20% plus rates of return. The long-term trend line growth is expected to be a little lower at about 7.6%, and that would indicate 8 or 9% long-term rates of return. So it's a very good company. Once again, we have a good scorecard. It's not as pristine as some that I've shown you here, but ironically, their 2-year forecast with a 20% margin of error has virtually been on the money. Anyway, I think JP Morgan is a diversified bank that's worth considering at today's valuation levels. It's obviously an excellent company in spite of what it went through during the Great Recession. Philip Morris, the old Philip Morris is Altria. I wanted to show the long-term view here. This was the spin-off of Kraft in the spinoff of Philip Morris International. So this is not a price drop. It's actually a reset. So I like to shorten this graph and bring it into what Philip Morris really looks like since it had the spinoffs. It's had 9.5% growth. It was pretty overvalued for most of 2016, a lot of 2015, but then coming into this year, it's now become attractive at a 15.7 PE, offers a 5.3% dividend yield, and you can see since 2009, it's generated a very excellent track record. It's outperformed the S&P on capital appreciation and dramatically outperformed it on dividend income, generating a 16.9% annualized rate of return versus 13.3 for the S&P, which I might add is very high. So I consider this an extremely high quality company that's become attractively valued for the first time in a couple of years. It's one that's worth looking at. With my next research candidate, I'm going to look at PepsiCo, and this is similar to Illinois Toolworks. This is one of the higher valued stocks based on earnings that I've looked at. You can see it's normally commanded a premium PE in the 20 range. The normal PE calculates at 21.7, but that's 20-ish times earnings. However, if I run it based on operating cash flow like I did with Illinois Toolworks, because again, its primary lure is the 3.5% dividend rate, you can see a very high correlation. We have had some weakness in operating cash flow the last couple of years, but it is expected to stabilize and grow again going forward. And consequently, I think Pepsi is a very attractive investment with the potential to generate approximately 10% rate of returns going forward. From an operating cash flow point of view, the analyst scorecard has been excellent. It's literally been 100%, meeting the analyst forecasts for both 1 and 2 year forward numbers. My next research candidate is Principal Financial Group. It's another financial company, however, it's life and health insurance in contrast to banks. Once again, you can see a little bit of cyclicality, but a good consistent earnings growth rate. If I look at just the last, coming out of the recession since 2010, it's grown about 8% a year. Now, the market normally trades this at about 11 PE. I want you to notice that over this time frame, but it's currently only trading at a 9.6 blended PE with a 3.9% dividend yield. Forecast to continue to grow at about the same 8 to 9% rate going forward, providing the potential for some excellent rates of return going forward. But if I do use the lower PE ratio, I still have 20% potential returns going forward with this company. Once again, it's got an excellent analyst scorecard. It's either met or beat estimates virtually 100% of the time. So I think this would be a great opportunity to buy this stock with a very attractive yield. It's got a good performance rate since 2009. Compared to the market, it's generated significantly more dividend income, slightly less capital appreciation, and its total return is just under the S&P. But I want to emphasize that's because this stock is undervalued where the S&P is currently overvalued, and I think that underperformance will change. Prudential is another life and health insurance company you might want to consider. It's obviously one of the more famous ones. Once again, we have double-digit earnings growth. We have a normal valuation of around 11 or 12 times earnings, but the stock is currently trading at 8.2 times earnings, offers a 3.7% dividend yield. Its historical track record has been stellar compared to the S&P, significantly more dividend income, slightly more capital appreciation, and a slightly better total return. Its analyst scorecard has also been very good. They have missed estimates 20% of the time on the 1 year forecast, but they've met everything 100% of the time on the 2 year. This stock does, if I go to the normal multiple of 10, it offers, significant rates of return going forward with the PE just expanding from 8 to 10. If the stock does move into a 15 PE, which it has traded at in past times when its operating earnings were good, the rates of return are really exceptional looking out to the next couple of years at least. My next research candidate would be Simon Property Group. This is the real estate investment trust. It's A-rated, does have a lot of debt, but I do want you to look at the long-term record of this company, and this is in spite of, what interest rates have been doing. Its track record has been really good. It's generated almost 10 times as much dividend income as the S&P. It's done 2.5 or 75,000, almost 76,000 versus 20,000. So it's averaging 11% capital growth versus 3.9. and a 13.4% rate of return versus 4.8. But here's what I want you to look at, and I want you to notice how clearly the reality of, in this case, funds from operations drive price. You can see that where the funds from operations went, the price did. You can clearly see periods of high valuation that revert to the mean. You can see periods of great undervaluation revert to the mean. The company is currently trading what I would consider to be fairly valued at a blended price to FFO of 14.6, offers a 4.6% dividend yield, and I think is very attractive as a dividend growth stock going forward. Forecasts going forward are for growth of about 5%, but it would indicate double-digit rates of return. The long-term growth is similarly at around just under 6%, again getting 9 and 10% rates of return going forward on this particular candidate. Our next candidate is another asset management company, State Street Corporation. Once again, we see significantly low valuation relative to historical norms. Blended P of 11.3, dividend yield 2.3%. It's A-rated and has no debt. It's a really exceptional company. It has produced a comparable rate of return to the S&P 500. But again, I want to emphasize that's on the basis of it being significantly undervalued, or measuring it when it's significantly undervalued relative to the S&P that is currently overvalued. It's expected to grow at over 12% a year going forward. That would indicate, double-digit rates of return at a 15 PE ratio. If we used our normal multiple, which is slightly lower, it would still be in the 30% range for the next year or so, and highs of about 27%. Long-term growth is expected to be just under 10% a year. Again, this is a great opportunity for a long-term investor to invest in a very high-quality company, A-rated, with a very excellent analyst scorecard. In other words, the analysts have got this company right. The next is U.S. Bank, an A-plus rated bank. Again, debt doesn't count in this example. It did go through some stress during the Great Recession. However, since coming out of the recession, it's been growing very nicely. Offered at a 12.9 PE multiple with a dividend yield of just under 3%. It has a really good track record since coming out of the recession, but it has underperformed the S&P. I might point that out, but again, it's undervalued relative to an overvalued S&P. Rates of return looking out for the next couple of years look very attractive. At the normal multiple, it would still be in the 20% range for the next year or so. So I consider U.S. Bank a very attractive research candidate as well. These are 15 stocks that I think are wonderful businesses that can be bought at fair or attractive prices today. I think you could actually build a portfolio utilizing, or at least lay the foundation of a dividend growth portfolio. I believe it's a total return opportunity. Again, it's a long-term opportunity because most of these stocks, you can see, are slightly out of favor. Anyway, that's been Chuck Carnevale saying thanks for watching. If you enjoyed the video or liked what you saw with Fast Graphs, simply email us at one of the emails on this screen or call us at the phone number, and we'd be delighted to show you how you can be a better investor with Fast Graphs. Thanks for watching.